Today we're going to be doing a tier list on stocks that could possibly 10x or they're completely trash and you should avoid them. Let's go ahead and jump right in. We're going to go with AppLovin stock. This stock is battered in the past couple months, but we can see by these green KPIs, the return on invested capital is 122%. So that is incredible. That's up there with Apple. And we can see that the revenue CAGR, they're making 30% revenue growth every year. I did 3 DCFs. You can check it out in this video. Basically, it's an ad tech software business. And it's basically with mobile gaming, but they're expanding to different avenues, and you can check it out in this video. And now we're going to jump right into ADT stock. It's a security stock. Basically, they'll come to your home, set up security, and then you're a customer for a very long time. You get a contract, and then if you try to leave, it's going to cost a lot of money to leave. However, they've been also battered, and they've had some insiders buying in the company, so that's the reason why I like them, and I think they're a plus EV bet. You can see by the IRR here, plus 25%. Basically, that means you're going to, after 5 years, you can actually think about it as if you invest $100, you can expect to make $300 after 5 years. So that'd be a 3-bagger. And then we go with NVDA. I'm not a semiconductor expert or anything like that. I'm just a normal guy. I know NVIDIA is like awesome. It's great for gaming computers, but for AI, I don't know crap about AI. So most of my stocks in my portfolio are not like with AI, but I understand advertising and how AI can help advertising. So that's why I invest in those types of businesses. So NVIDIA, we see that it has multiple green KPIs. The revenue growth is insane, 67%. Their debt to equity is 0.1, so that means they're not leveraged at all. Return on invested capital, 125%. That's up there with Apple, just like I said with AppLovin. We can see that I did a DCF with, it showed 19%, but in my DCF, I put the probability of the bear case at 66% because I have no idea when the cycle will end, So I have to take that into account in my investment process. And I'm not an expert in chip stocks, semiconductors, so I don't know when the cycle will end. So this is why I'm discounting these semiconductors. I'm passing. I don't know what to do with those. So we're just passing on those. So AMD, same thing as NVIDIA. NVIDIA has some CUDA, so it's like I'm not an expert, so I'm not going to try to explain that. You can look up NVIDIA videos if you want to try to become an expert on that. Hood, I am a user of Hood. I'm very happy with Hood. I feel like under $75, it's a good stock. Right now, Hood stock is like $110, I think. It's $108. So at $75, I was really liking Hood stock, but at the price right now, I put it in my watch list. 36% revenue CAGR, that's pretty good. Debt to equity 0.2. And my IRR says it's only a 16%. So remember, I'm trying to get above a 20% IRR. So we're keeping this in our watch list. You have to be careful with these types of stocks. They're also cyclical. So you have to really make sure you're getting a good return on those stocks. Meta, I think, is a bargain, so I wouldn't mind having this in my portfolio. I should probably consider adding it. However, I'm also invested in Reddit stock, so I wouldn't be well diversified if I own Reddit and Meta. So I just decided to take the one with the higher IRR at the time. So anyways, we know Meta. Meta is like Instagram. It's the best in the business for advertising. Return on invested capital, 24%. Debt to equity, 0.4. 19% revenue cap. And they have so many different things that they're doing, like the Meta glasses. The metaverse was a complete waste of CapEx. However, Mark Zuckerberg is a great CEO. He's always investing in different things. WhatsApp, he's going to monetize WhatsApp. They're going into some AI stuff. Like I'm not aware of AI stuff, but they're spending a ton of CapEx. So the market's kind of worried about how much CapEx spending they're using. So that's another reason why I haven't really bought it. I bought In and Out in the past, but that's one thing I'm not too sure about. And another reason why I bought Reddit stock is because they're not going down the whole AI investing, spending a ton of CapEx on AI. So Decker stock, it's a watch list stock, consumer cyclical. They own like Hoka's and Uggs. Return on invested capital, 87%. That's actually insane. I didn't think it would be that high. PE ratio, 13. Revenue CAGR, 17%. So pretty good revenue growth. Not much debt. So 17% IRR, that's a pretty good investment. But remember, I'm trying to get that 20%. I'm trying to get bargains and plus EV stocks. Comcast. So Comcast plus 24% IRR, triple your money over 5 years. Price to free cash flow is 6 and PE ratio is 9. Right now they're getting that conglomerate discount. So I think that in a year when they spin off those universal assets, like the theme parks that are growing pretty fast and Peacock, which just turned profitable, I think all the multiples will re-rate and it'll actually boost the stock price. So I'm pretty bullish on Comcast. We can see Adobe stock. So I was in Adobe stock. I actually bought it around 200 and I sold that around 250. Right now the IRR is around 12%, but you could see how important paying attention to insiders buying the company. I'm going to go to plusevbagholder.com real quick. You can see that the insider bought at the literal bottom. You can see at 193, he bought $2 million worth of Adobe stock. And that's an insider. That's like a director of the company. Rick David, he bought $2 million. And we can see that the stock price has just gone up since then. But in the past 3 years, it's just been a complete downtrend, and then he literally timed the bottom. And that's why I have an insider buying screener where you can find these insiders. All of these stocks have insider buying, and you could investigate them pretty easily. Just like click on one, and then you can see where the insiders bought with the orange dots, and then you can do your homework here. So anyways, let's get back to Netflix. Netflix is going to be 17% IRR, so we can probably put them around the watch list. If they dropped, what is Netflix price at right now? It's at 79, so probably it's a watch list stock. High return on invested capital, 39%. Revenue CAGR is 13%, so that's pretty good. Debt to equity, 0.5. The bullish thing about Netflix is if they ever figure out like their advertising, how to like monetize that better, I feel like they should have more QR codes on all the advertisements, because mostly I feel like they just do brand advertising, and brand advertising is where like an Old Spice commercial, people are not going to go to Old Spice and buy it. They might buy Old Spice whenever they go to the grocery store and they see Old Spice, they need deodorant, they'll pick it up from there because they remember from the commercial that it's like, oh, you're gonna get ladies if you wear Old Spice. So that's what brand advertising is, and Netflix needs to work on their direct response advertising. Basically, like if you put a QR code on the screen, then you can directly respond to that ad and it can directly make more revenue for the advertiser. But I do like Netflix. I'm a subscriber personally, and I wouldn't mind having this stock in my portfolio if it was a little bit cheaper. SOFI, I'm going to pass. It's hard to value banks that are like just giving out a ton of personal loans. So that's what SOFI kind of does. They make a lot of money from personal loans. I am a user of SOFI. I do like their business, how they provide high yield APY, and the revenue growth is pretty insane, 45%. Debt to equity is 0.3. It's just hard to model them because you don't know the types of loans that they're giving out. And when you don't know that, you don't know how to evaluate risk in the business. And I just don't feel like digging that deep into that. I am putting it in the plus EV S tier. I made a video on TMDX, but I won't go into too much detail. Basically, they're a vertically integrated organ procurement and delivery company. So they own the doctors and they own the pilots. They own the planes, and organs are expensive. So also investing in this company, you can feel like you're helping save lives because they're researching on how to keep organs alive for longer. And when organs just die because they can't live in a cold ice box, this company is trying to make the organs live longer so then they can save more people. CELH. So I love Alani. However, they just have so many competitors. Oh, I think the pizza's ready. It needs another minute. Floor and Decor stock. Floor and Decor stock is basically just a flooring company in a warehouse, and they have so many options, and they have lots of workers that like them. And I believe if the housing market turns, then they can be 5x. They could be a big winner. You can check my DCF real quick on Floor and Decor. Let's go to Floor and Decor here. Scroll all the way down. You can see a 6-bagger. They could be a 6-bagger. They're 195 implied fair value if the bull case happens, which gives it a 55%. If you do the blended IRR, basically take into account the bear case, base case, and bull case, and evenly distribute them, we get a 20% IRR or a 55% upside in the stock. So I do think they are a bargain, so we're going to put them in the bargain territory. They went up a little bit from when I bought it at 45 to 60, but I wouldn't mind buying back if they keep dropping, because this is a cyclical company. So when the housing market is booming, people are redoing their floors, then you want to buy it on a downturn. You don't want to be buying when the housing market's hot already, because the stock's going to be already up. But yeah, it's probably a bargain to buy now and then wait for the housing market to turn. Lululemon, I like Lululemon clothes. I like them for men and women. I own 2 pairs of shorts from them. I'm putting them in the watch list just because I feel like their margins are compressing from the Amex deals. So that's actually boosting revenue, but it's at a cost of the margins. So I'm putting them in the watch list. They are growing in China and internationally, but fashion is fickle. So you have to really get a good discount on them to put them in your portfolio. But you can see a lot of green KPIs here. So the return on invested capital is 27%. So they're open up in pretty good locations. 0.4 debt to equity, 20% revenue in the past 5 years. However, it's been slowing down pretty bad in the past year. There's a lot of CEO turnover. You can see, let's see, revenue growth here, plus 19%, plus 10%, 5%. Last quarter was 4%, and you see the margin right there is 11%. So I feel like the credit cards they're offering credits, but it's cutting into the margins. Anyways, let's go to Reddit. I think Reddit stock is S tier. TMDX has actually been going up. I bought it at 75, so I'm gonna put it at the end S tier because it's been going up pretty high. Reddit, I'll put it like this. Reddit stock, 24% IRR. Basically, this bet is saying that the AI licensing deals are going to be dynamic pricing. The main things about Reddit I like are, babe, I'm making a YouTube video.
Oh, no wonder. I was going to say, why are you such in a rush?
Is it ready?
You're doing a thing about fantasy football?
No, this is not fantasy football. I do like CROX stock. However, it's gone up from $75 up to like $120. So I'm going to be completely passing on CROX, and I would not recommend you guys look into them because they've been going up too quickly. And I don't like that Hey Dudes acquisition, so I'm questionable about the management. Charter, I'm going to pass on them. Their debt load is kind of crazy, and I feel like it's a risk that you don't have to take when you could just go with Comcast. But the bull case is that it could 10x, but I'm not a big fan of them. Chipotle, I absolutely love Chipotle. However, their multiple is like 33, and they're just not growing as quickly. Yeah, I like Chipotle, but discounted cash flow says absolutely not. I would even put them in the bag holder tier. You gotta wait for a better day for Chipotle. And then Chili's, I was an investor in Chili's at around 140, but now it's around 225. I'm gonna put them in the pass. Just like don't even look at them because they're too expensive right now. But good companies, they usually surprise to the upside, and I can't put those in the bag holder tier. Let's see, Nike, this is a bag holder stock. Like, this is one stock I actually shorted. They're they have such a high multiple for a very low growth rate, and the management has been terrible. They took the Nike shoes outside of the stores and they were just gonna do like a online model where people are just gonna buy shoes online. Whenever you had all that real estate, like you really just screwed your business over by doing that. And now they have to renegotiate, get into all these stores. So yeah, just really bad, really bad. Wix, I'm gonna pass on them. You know what? They go in the bag holder tier, even though basically their stock based compensation is so high. They did a Dutch auction. It was buying back like 25% of the company's shares at $90, and then the stock dropped to $45. So they destroyed a lot of capital there. However, they are making a little comeback. I do believe in vibe coding. You can tell by my website, fully vibe coded. However, I did not use Wix, so I'd say there's considerable competitors, and I don't think they have any moat at all. And I'm skeptical that the management will figure it out. Hertz stock. This is another speculative stock. I would say that they're a bargain. However, I would only, since they're a speculative stock, I would only put like under 3% of my portfolio into them. I have a whole video on Hertz stock. You can check it out. Let's see. We're going to fire through the rest of these. Coca-Cola, we're going to pass. Just pass on that one because it's so big and it's just too boring. I want to get out of that stock. Lifetime Fitness. So these are like gym memberships for really rich people. And I am bullish on the K-shaped economy. However, the multiple is still a little high for me. And I feel like there's better stocks up here that I would like to invest in. Monster, I'm going to pass on them as well. Okay, we're going to put them in the pass tier. And then Pepsi, we're going to put them in the pass tier. Maybe we could put NVDA in the watch, AMD in the watch, Monster in there. Rocket, we're going to put in the watch tier because I don't know how to evaluate the loans that they're giving. However, I really like their business model, how they actually acquired Redfin, and they're getting more vertically integrated. So I do like that. So they're in the watch tier. Zillow, I like Zillow. I want to see them become a little more cheap. You can see they need to get rid of some stock-based compensation, and then they could become a bargain eventually. Ustock, I just found the stock actually from my trending screener. You can see on my trending screener, it's basically the top mentioned Reddit stocks and Wall Street Bet mentions. You can see all the way over here. Let's type in U. Right here. Okay, it was the 13th. I investigated this stock and the Clear Airport Security. Rich people with Amex Platinum cards will pay like $200 a year to just skip the security line, and they're in a bunch of airports, and I've seen people just walk by. So I feel like they have a high risk but also a high reward. So we can see that the stock price has been going down around $62 or $69, 52-week high, and $29. I did recently buy some. You can check my Discord for my portfolio holdings, or you can subscribe to my website. Let's go ahead and check out U stock. I think that the bull case, you can see that Q2 they had a 27% revenue growth. Revenue has just been going up every single quarter. So 26% revenue growth in the past quarter. And let me just that. There we go. Let's look at operating income. It's just been it doubled. Operating income doubled since last year. And then free cash flow, it's almost doubled, 65%. Operating margin, 19% to 30%. So everything is going up. It's operating leverage. So what are the risks for this business? We can see that the bull case is a 7-bagger. And then the bear case, we can say that the Amex stops giving out credits, and we can say that their margins drop to 16%. The free cash flow drops to 30%, and then 14. So blended IRR would be 31%. Let's say 50. The bear case happens 25. It would be a 25% IRR. So that's what I would put in the S tier. Yeah, so I'm gonna do a more in-depth analysis on you. But I'm bullish, but also cautious. And then KSS stock, you can check it out right here. These are obviously the stocks I hold in my portfolio on plusevbackholder.com. And you can do your own stock research as well. So subscribe. I feel like I have the best screener out there. You can screen for these are all insider buying stocks, and then it also separates them by value KPIs. And then also you can find trending stocks, and then you can keep your watch list stocks. You can add all these stocks on your left or on your watch list, and you can track when insiders buy on your watch list, and you can see which stocks are oversold or undersold right here. Leave your best stock picks down in the comment section below. I want to see your tier list. And if you enjoyed this video, consider joining the Discord community in the link in the description. If you want to save time researching stocks, go ahead and hit that free trial in the description. You guys get 7 free days. And if you don't like it, you can just unsubscribe for free. So no problem. Thanks for watching. And if you guys enjoyed this video, you might enjoy my App 11 stock analysis. So check it out.